All right, in order to understand the discount rate and the reserve ratio, you need to understand how banking works. So, banks sell stock to people who want to invest and they'll make a profit, and that's how they get started. Then they get a charter, and then they get people to come deposit. They get you to deposit money in a savings account because they pay you interest. They also get money from you by charging you fees on a checking account. At least some banks do. And then with that money, the whole purpose of the bank is to loan out money. So right now they might be paying you 0.75% on your savings account, but they're lending money out to people that are going to pay 3% or 5% or 7% on their loans. So that additional money is where they make their profit. So when banks make loans, they create money because if you come in and borrow money for a restaurant, well, that $10,000 went out to you, but that money also belongs to the depositor. So if Maquela comes in and puts in $100,000 in the bank, and then Prince comes and borrows $100,000, then Maquela's money belongs to her, but it also has been loaned out to Prince, and there's an expansion that happens. Now, the good news is if Lauren and Wyatt and everyone else has money in the bank will always have money for you when you need it. But if you think about it, I don't really want the bank loaning out my money. I mean, I don't care what they do with your money, and I certainly want to borrow from them when I need a loan. But I also want to know that my money is safe and sound. One group that organizes that is with a group called the FDIC, the Federal Deposit Insurance Corporation. They insure banks, so they inspect banks to make sure that they've got enough money, that they're doing a good job, and they insure them, meaning that if Maquila comes in and wants her money back and the bank can't give it to her, the bank will use its insurance and make the money available to her. And then the FDIC and potentially the Federal Reserve will come in and straighten that bank out. The Federal Reserve requires that banks keep some money in reserve. And in fact, the bank has to create a savings account with their Federal Reserve branch. The required reserve ratio is 10% of deposits right now. And that's gone down over time. It used to be as high as 25%, but it's 10%. It's been 10% for my lifetime. So it's pretty solid. So the bank has to keep that amount of money on hand, and the FDIC insures individual deposits up to $250,000. That was $100,000 before the recession of 2009. But that means for every Social Security number on a bank account, you have $250,000. So if you and your spouse had it, you'd have up to $500,000 in cash that's insured. Businesses also benefit from this insurance, but be aware that a county government or a school board or something right before payroll, they're going to have a whole lot more money than that. So when banks collapse, some folks do lose money, but most individual depositors are not at risk. The reserve requirement is one of the tools of the Federal Reserve, and they can adjust the reserve requirement by allowing banks to lend more money out. If they increase the reserve requirement, banks keep more money and they can't make as many loans. That would be contractionary policy. If they decrease the reserve requirement, banks keep less money, and that's more money they can loan out to their customers. That would be expansionary policy.
Hey, Curious George. Welcome to the Bank of Reagan. You say you want to borrow money to open a banana stand? I don't have any money. All my money is sitting in the Federal Reserve to meet the Federal Reserve ratio. I'm here to verify this word, the reserve ratio. It looks like it's locked, but it's not really. Thanks. Cheers, George. Now I have lots of money. I can make you a loan.
The Federal Reserve rarely changes this because it would be disruptive to normal banking practice. So normally they keep the reserve requirement where it is. But just like you can put money in your savings account, the Fed also pays interest on reserves. They'll pay interest on required reserves and then can pay interest on excess reserves, extra money that you put into the Federal Reserve to keep it safe. And banks want to make money, and the Federal Reserve is a very safe place to put it. So versus your loan for a restaurant that has a 50% chance of closing during a good economy, banks can be sure 100% chance of getting paid back by the Federal Reserve, even though they're not going to get paid very much. So they can make money without loaning it out, and that's a great way to slow the economy down. And this actually has become the most common tool that the Federal Reserve uses right now, is this interest on reserves. During the COVID-19 crisis, they've actually dropped the interest rate to 0. But if they raise this rate, then encourage banks to put money in with the Fed instead of lending it out into the economy, and it slows an expansionary monetary policy down so that we don't get going too fast and we don't have an economic crash due to economic reasons and not external reasons like this virus that we're dealing with right now.
We think there should be less money. We're going to raise the interest rate reserves and exit reserves. Sorry, George, you're too risky. I put my money with the Fed. Man, the Fed's paying a lot of money. I'm going to give my money to them. That's how the Federal Reserve works. Contractions, ooh, na, na.